Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from toasty Palm Springs and the greater Coachella Valley area. We're still in under 100 degrees, only about 94 according to the weather report on my phone. But we're going to toast up this weekend. By Monday, it looks like we're going to be hitting 110. So summer looks like has finally arrived. And of course, here at the home of the what some folks refer to as the fifth major, and I'm talking about tennis, the BNP Paribas Open. Of course, here locally, then we're kind of focused on what's going on in the tennis world, the French Open. So looking forward to that this weekend. Looks like the women's final is set. Coco Gauff won her match and will be facing Sabalenka for the final, it looks like. And then we're still waiting for the men's semis to get finished. And of course, Djokovic is in the running for that, as well as Alvarez from Spain. So some exciting tennis this weekend. I'm looking forward to it. And of course, we also have the NBA finals. So with that end of your sports report, if you will, let's go into the mortgage rate and bond market. A couple of things. And again, I feel like I'm just repeating myself. I'm a broken record that just keeps saying the same thing over and over again. But that's actually good news. If you look at our rate grid, we're still in the sixes. And you know what, folks? We're going to be in the sixes, I'm going to predict, for basically the balance of the year. So as I've said many times, you really should consider, if you're still on the sidelines waiting, that has already cost you money. As I learned at a recent presentation by Jordan Levine, the chief economist for the California Association of Realtors, he has repeatedly pointed out that those who have been waiting, listening to, as he describes it, your brother-in-law who keeps telling you, no, wait for home prices to fall, wait for rates to fall, it's not the right time to buy. Of course, he's pointed out repeatedly in many of his presentations over the last couple of years that has cost that prospective home buyer. They should have gotten into the home ownership realm earlier, and that would have paid off well in terms of appreciation in that home. So when you look at the rate grid, same story. We're in the mid sixes. We've been in the mid sixes for quite some time, whether it's conforming loans, FHA, VA, barely over 6. The buy downs, 3-2-1s, 2-1s can get you into 3s or 4s. So these rates are good. They're stable. We haven't seen much change at all. And so that's, again, why I think you shouldn't wait any longer and consider getting into home buying if that's anywhere near your short to medium term goals. When you look at the bond chart, which Jeff's going to pull up, it's pretty good news. When you look at that 5-day a 5-day chart going back to last Friday, we've had some nice reduction in the 10-year bond yield. We were getting up over 450 there, and now we're barely under 440. In fact, early this morning it was down to 435. So that should be embraced as good news and trending in the right direction, albeit maybe not as low as we'd like to see it, but it's still good to see this kind of chart. And of course, the dip wasn't on Wednesday, as Jeff's theory used to suggest. It happened really more early this morning, a little bit of an uptick as the market closed this afternoon. So we'll see what happens tomorrow. So let me get into the data points that have been released this week that I think has some effect on where we're at with mortgage rates. Now, when you look at this list, it's going to all look like kind of bad news, but I'll comment on that once we go over the numbers. Factory orders, that was released earlier in this week, down 3.7% in April after being higher in March. Then we have JOLTS, that's the Job Opening and Labor Turnover Survey. There's now 7.4 million of job openings in April. That's actually up from 7.2 million. That is suggesting that businesses are slowing up their hiring. They're slow to hire. And then we had ADP came out with their report of new private job creation. I want to point out ADP, when they provide their job numbers every month, those are private jobs. Their number does not include government jobs. And of course, there was only 37,000 new jobs again, private jobs in May, which suggested, in fact, that was the weakest report from ADP in 2 years. Then we had the Fed Beige Book. That's something that's released periodically by the Fed. and it describes basically what the focus is of the Federal Reserve Committee. And what they are observing is the economy did stall in May, consumer spending did pull back, and business did delay hiring, as we again just touched on with both the JOLTS report as well as the ADP number. So yeah, that's all somewhat negative news, right? And of course, tomorrow will be a big day because we have the U.S. employment and unemployment report. The U.S. employment report, of course, is going to be new jobs that'll be released. It is forecast to be down 125,000 versus 177 in April. Why that number is so much bigger than the ADP is because that job number does include government jobs, not just private companies. And then the unemployment rate is actually forecast to be steady at 4.2. So as Jeff just pulled up, this looks like a bunch of bad news. So how does this translate into an opportunity for home buyers? A couple things to note. One, and I didn't put it on the screen today, but I should have. At the end of last week, if you watched last week's show, we mentioned the PCE, the Personal Consumption Expenditures Index. That's the Fed's favorite inflation target. Well, guess what? It came out cooler than expected, 2.1%. And if that sounds like a familiar number, remember the Fed is focused on getting the inflation rate. Their target is 2%. So the PCE was very close to that. And that's on top of the cooler CPI and PPI numbers earlier in May. So the latest inflation numbers are all favorable. They seem to suggest that inflation is coming down. So that's good news. And then when you see these economic data points this week that suggest that the economy is slowing down, what that's done, the combination of that, these slowing economic data points and the inflation numbers that have actually been pretty good and lower than expected, that has now caused a big increase in the futures market for the next Fed meeting, where they'll be looking at lowering the Fed funds rate. Now, the percentage prediction of that happening with a reduction, probably 0.25%, is way up. So the combination of very good inflation numbers and some of these what appear to be weak economic data points, remember, a poor economy is generally good for mortgage rates. So while it may cause some prospective buyers to be uneasy about what's happening with the economy, am I going to lose my job? I think overall the economy is really not that bad. I don't think we're going to see any big downturn. Yeah, softening a little bit. And I would argue most of this is psychological, because there's still a lot of anxiety and kind of a point in time where businesses are sort of hesitating to hire because they don't know what all this tariff stuff is going to ultimately, how it's going to play out and how it's going to affect their cost of goods and so forth. So I think this is more about anticipation and the anxiety, the psychological impacts of all this trade and tariff turmoil that really hasn't fully come through in the numbers. I think the April numbers are maybe the first hint, but overall they're not horribly bad. And you combine that with much improved inflation numbers. Again, the predictions are the Fed is bracing for the first reduction that we've seen in several months now, going back to December was the last one. And so if that happens, while I will continue to emphasize Fed lowering the Fed fund rate, by itself in a vacuum doesn't directly correlate to mortgages at all. But long term, it's the right direction. So we see that reduction and maybe another one or two later this year, that could help us with the mortgage rates. So I really think overall, don't get doom and gloom about these numbers. Realize that rates are stable and maybe trending slightly lower. And that gives you a great opportunity to get into the market. And to the extent the data point numbers, as they are weakening, may affect the market, what it may do is actually potentially motivate some homeowners to go ahead and choose now to sell. So that would give you more inventory, which we're already seeing more inventory, which that's part of the advantage for a prospective buyer right now. Growing inventory with rates that are stable and maybe trending downward, put those two together, it's a great time to buy. Don't listen to your brother-in-law anymore, as Jordan Levine would say, and consider getting into the market now. I'd be happy to sit down with you, have a consultation, show you the numbers, and help you decide if now is the right time. So don't get too doom and gloom about these numbers. In the long run, they could actually help us in terms of mortgage rates and home buying. So with that, we're going to go ahead and get into our discussion with Jeff. We're going to talk a little bit about things like reverse mortgages.
Hey, Art, how are you?
Good. How are you?
Good. So I'd forgotten that this weekend was the finals for the tennis. So I'm looking forward to that. It ought to be
Yep.
a lot of fun.
Yep.
Yeah, I was looking at as you were talking about your rates. One thing I noticed is it seems like the HELOCs and HELoans continue to go down. I mean, it's hard not to, if you have equity in your home or you're thinking about doing something, that not to exercise some action on that. Because I remember not long ago that was up around 9, and now it's, well, you saw what it was, very low.
Well, yeah. In fact, it's interesting you point that out because I just recently sent out some numbers, a worksheet to a homeowner looking to get an equity loan to build a pool. And in their case, I showed them both HELOCs and a HE loan. And one of the things I'm seeing in terms of inquiries about equity loans is more focus on the HE loan. Again, the HE loan is just a traditional fixed rate mortgage. It's not a line of credit, so you don't get to draw on it from time to time. You get all your money at once. But when you think about it, in this particular homeowner's case, they had a specific need. They want to build a pool. And they're not really looking for the HELOC to be some sort of rainy day fund that they're going to tap into later. So in that regard, I sent them a worksheet where they had a lot of equity, good credit score. I was able to send them a worksheet with a 20-year fixed second mortgage for $100,000 at 7.6%.
Wow.
That's pretty darn good when you consider that first mortgages are, in the mid sixes. Second mortgages are going to carry a higher rate than a first because they're in second position. There's more risk to the lender. But when you get that kind of spread narrowing to what is basically slightly over 1% from the first to the second, that's a pretty good outcome. And our HELOC lender that we use most of the time now, depending on credit score and the right loan to value, we can actually offer HELOCs at prime rate, which is what most HELOCs are tied to as the index, prime rate plus 0 margin over that rate. Now, with that being the case, that means HELOCs could be as low as 7.5.
Wow.
And to the extent you're looking at a HELOC, if the Fed does start ramping up rate reductions for the rest of this year, that's going to directly help you as a HELOC borrower because you're probably going to have a HELOC tied to prime. And every time the Fed funds rate goes down, unlike a 30-year mortgage, the prime rate immediately reacts to the Fed funds rate movement. So if the Fed funds goes down a quarter, the prime rate goes down a quarter, your HELOC loan rate is going to go down by the same amount immediately. Again, that's not like a 30-year fixed mortgage. So they're two different things. But if you know that, that could be a reason why looking at a HELOC now, if you've been holding off, is probably a good thing to do.
Makes great sense. The other thing I wanted to ask you about too is the fact that the Fed is now more encouraged, and it seems like the probability of them having a rate reduction in the next meeting is close to a reality, even though it doesn't directly affect the mortgage rates, the long-term mortgage rates. What does that do for business owners? Does that allow them to access capital that for less money, and maybe they're thinking, okay, I need to expand, I can do this? Does that help, overall for the economy?
Oh, absolutely. Of course, think about, again, we talk about HELOCs are tied to the prime rate. Well, the prime rate, historically was a rate that was offered by, to banks' best customers. In a lot of cases, those were companies, corporations. And so when you start to see the Fed funds rate come down, that is going to more directly help businesses, corporations, employers reduce their cost of borrowing, which that ultimately should be a good thing for those companies and good for the economy overall. And of course, as we know, there's a guy lives in Washington, D.C. in this big white house, and he's been pounding the Fed about lower rates, lower rates, lower rates. And not that he's really got the expertise to decide when that's supposed to happen, but hey, let's root for him to be successful, because we do want to see the Fed funds rate go down, because eventually it will help the mortgage component as well.
Well, it seems like it's not only, it does ripple through our entire economy, but it seems like it's such a mindset shift, isn't it?
Oh, yeah, for sure. I was at the weekly caravan meeting with the Palm Springs Realtors yesterday, and the title rep, came over to talk to me and said one of my friendly competitors, another mortgage originator here in town, had alerted him, hey, you know, uh, big possibility rates are going to come down. And I said, really? Why? What did she say about that? And he made reference to the fact that the prediction now is a much higher percentage probability the Fed's going to lower the Fed fund rate. And I'm like, okay, true, but come on, you know better. You're in the business, basically, a title. You know how this works. Don't get your hopes up that means mortgages are going to be down 0.25% if that's what they do. And of course, what did I do? I said, remember last September when the Fed went down 0.5% in the Fed funds rate? What happened to mortgages? Within 30 days, they were up 1% higher, not lower. So
Yeah.
look at that with caution, but overall, eventually trickle down, it will help.
Now, did you happen to say, don't listen to your brother-in-law?
No, not to him, but I love that. I mean, Jordan Levine uses that a lot in his presentations, and it's really true because so many people, if you're a renter and you're thinking about buying a home, or maybe you're a homeowner and you're thinking about pulling your equity, everyone has some sort of trusted advisor. So I don't really mean to demean that process. That's a good thing, but sometimes those trusted advisors seem to portray that they might know more than they really know. So I think you have to maybe at least get more than one opinion, get some opinion other than your brother-in-law, maybe somebody who's a little bit more objective like us, and let us give you a balanced view of what your options are.
Yeah, that's great. Well, I just want to remind everybody this is a live program, and we're going to be talking about a subject on reverse mortgages for seniors. And if you have questions, please put them in the comments. We'll put them on there to Art because his saying is about questions. What is that, Art?
We have the answers, and they're on the house.
That's right. So let's jump in. So, a lot of times they keep saying, X number of people are retiring every day or turning 65 every day, which means retirement, theoretically. And, my question is, hey, what's your strategy? Because you have that person on the left who says, hey, we're all set. We're ready to go. We're going to enjoy our life. And the other one is like, I'm a little concerned. I'm not ready. And before I used to think, that must be a small amount. But that survey you shared a few months ago, 71% of seniors are concerned about their retirement. And basically they're saying, hey, I'm concerned about running out of money before I run out of life. Right. And so I thought, this is a perfect time for you to kind of unpack that again and help us kind of refresh our memories of things when it comes to reverse mortgages.
Sure. Be happy to do that.
Great. So first of all, I say retirement. Do you have a plan? Well, sometimes you have a plan. Like, I'm just going to get up every day and hope it's going to work out. Gang, that's not a plan. That's not a plan. So, one of it says a lot of senior homeowners are house rich but cash constrained. Can you walk us through how a reverse mortgage can turn that around without requiring them to sell or leave their home?
Sure. I mean, that's the basic issue with a reverse mortgage. We have so many homeowners who are in that situation. They don't have a lot of recurring monthly income. They may have some savings or retirement accounts, but maybe not a tremendous amount. So where they're in a vulnerable position where they may not have access to income or liquid assets sufficient to, thoroughly and adequately enjoy their senior years. The reverse mortgage product was designed specifically for that. But here's what's interesting about the reverse mortgages currently. The baby boomers generation is very large, getting older every day. It's much bigger than it used to be in terms of previous generations of senior homeowners. And yet, reverse mortgage loan volume is very low compared to historically. In fact, consider this. The peak in reverse mortgage loan volume in the U.S. was in 2009 when almost 115,000 reverse mortgages were made. Well, last year in 2024, only about 27,000 reverse mortgages were made. And so that's odd because we've had a big increase in home value since 2019, pre-pandemic to now. So theoretically, there should be more equity available for that senior homeowner to access. And yet they aren't doing that in nearly the numbers as before. And we'll talk about that a little bit in a minute. But in the meantime, what I think the other little sliver of a data point is 74% of senior homeowners really don't know much of anything about a reverse mortgage or how they work. So I think that fear of just the unknown is keeping them from really looking into it. And they should, because the key aspect, excuse me, of the reverse mortgage is it gives you access to your equity to address the concern about having sufficient income, sufficient cash to survive adequately and comfortably in your senior years. The core product is called a HECM, Home Equity Conversion Mortgage. That's actually an FHA loan. And that is the most popular option. It works in most cases, not all. The beauty of it is it gives that homeowner the opportunity, if you're free and clear on your home and you're over 62, and particularly as you get older beyond 62, you get the ability to access cash, and you can get it in a multiple number of ways. You can get it as a lump sum. You can get it with monthly payments for a specific term, like 10 or 20 years. You can get a monthly payment for your lifetime, and that's calculated based on your current age up to age 100. And if you live to 100, by the way, you'll keep getting those payments all the way up to that point and beyond. Or fourth option, a line of credit. And that is a very good option, underappreciated, underutilized, not well known by senior homeowners. And you can get the cash through a combination of those four ways that I just described. Most popular is you take some amount of cash at closing. You have to anyway to cover closing costs. Maybe you have a small mortgage, so that has to be paid off. And then the remaining amount, a lot of homeowners will take a portion of that remaining amount at closing, and you can up to 60% of the loan amount available to you. And then the rest is set up as a line of credit that you can access after 1 year. And the benefit of that is if you don't touch the line of credit right away, it's a zero balance. You're not accruing any interest. And the line of credit is growing over time, the credit limit. So as a consequence, using a reverse mortgage with those different options to access cash without the need to make a payment, although again, I stress, you can make a payment if you want to. So if you're concerned about that loan balance growing, you can avoid that or partially avoid that if you want to make some payments. But it's reality. A lot of homeowners, the reason they're getting this reverse mortgage is they are short on cash, either monthly income or cash in the bank. And so they need either the relief of getting rid of the small mortgage they have now, as well as accessing cash, or if they're already are free and clear, then access cash and be able to do it in a variety of ways and in a controlled way with the benefit of getting more later if you set up most of it with a line of credit. So a reverse mortgage continues to be an underappreciated product, and we're doing everything we can to raise awareness and get people to realize they should take a harder look at this. It can greatly improve your financial situation in your senior years.
Well, Art, one of the things I was interested in is that still is that fear of people. And I think it's because, like you said, 74% of the people really don't know that much about a reverse mortgage, is they think, well, that horror story of a spouse and a husband and wife or spouses, and that one person passes away, that means they have to move out and their home is sold out from underneath them. That's not true, is it?
Not at all. Now, it used to be. Several years ago, the problem with a reverse mortgage, and this probably created some negative impression of reverse mortgages that carry on to today. Not too many years ago, if you had a married couple owning a home, it's free and clear, they want to get a reverse mortgage. Let's say one person is 75, but the other person is 60. Well, of course, 62 is the minimum age for eligibility. Several years ago, what had to happen in that case was the younger spouse could not be on the loan because they weren't 62. So the loan would be arranged only in the older spouse's name. And of course, as we've discussed before, the reverse mortgage doesn't have to be paid back until you either pass away or you vacate the home for more than 12 months. And that's usually because you can no longer live in the home on your own and you have to move into assisted living, and you're not going to be in a situation where you'll be able to come back. Either one of those events causes a need to pay off the loan. So again, not too many years ago, in that situation, that younger spouse would have no option other than they'd have to vacate because they weren't on the loan to start with. And they would be forced to sell the home because they weren't a borrower on that loan. That is gone. That's not the way it works anymore. You are safe as a couple if one of you is under the 62 eligibility. But you'll still both be on the loan. But here's the trade-off. The loan amount available to you will be lower because it's going to be based on the youngest borrower of the two. And so remember, it's an actuarial calculation because they have to take into account how much interest is going to accrue on that balance if you don't make payments. Well, obviously, much more interest could accrue if the younger borrower is 60 versus the older borrower at 75. So they have to take that into account. That means you're going to get access to less cash. But at least in that scenario, the younger spouse is protected. And if the older spouse does pass away first, which statistically is likely, that younger spouse can remain comfortably in their home. They're not forced to vacate or sell it.
I think that's got to be comforting news to everyone, realizing that it's not some kind of way for the bank to get my home, or my surviving spouse is dealing with all this. That's of a concern. So that's a nice thing. Now, I alluded to it earlier about the concern about the survey says over 70% of seniors are concerned about outliving their savings. How does a reverse mortgage help reduce this financial fear, Art?
Yeah, we see this a lot. And the way it usually ends up working is, the senior homeowner may have some savings, retirement accounts, IRAs, etc. They have limited income. Maybe they're retired fully. They're not working and they're on Social Security. They don't have a lot of other income sources. So they're drawing on that savings monthly to live on, whether it's through a large savings account or maybe they got an IRA with a pretty good balance, and they've set up a recurring monthly draw to live on. We see that quite a bit. But here's the problem. The problem is in a lot of those cases, that homeowner is still worried about drawing all that money out before they pass on. And the problem with that, of course, is then what do you do? And that's why so often the reverse mortgage ends up being the loan of last resort. So many homeowners, because they think, oh, I'm fine, I got some money in the bank, I think I could be okay. Of course, if they talk to any skilled financial advisor, who would look at the numbers and say, no, you run the risk of running out of money while you're still living. That's not a good situation to be in. But so often people think that, and then what they do is they exhaust their savings, they exhaust their IRA account that they're drawing on, and then they're scrambling to get the reverse mortgage as a last resort. We encourage folks, don't think of the reverse mortgage as that last resort option. Consider it earlier in your financial strategy as a component to help you maintain your assets and have enough cash to live on for the duration. And what that brings up is a concept that we like to refer to, sequence of return risk. What we suggest folks do is, even if you have a sizable IRA account, maybe you're drawing on every month, or savings account, or both, don't wait until you've exhausted all that money. Instead, look at a reverse mortgage much earlier. Get it, apply for it, get it attached to your house. And if you don't need a whole lot of money initially, after your mandatory obligations, closing costs, maybe a small mortgage you're paying off, property taxes that are due or insurance that's due, then put the rest in a line of credit. Again, that'll grow over time if there's no balance on it. And then when you have a situation like we had just a couple months ago, remember, the stock market took a dive, significant dive, that can really harm your withdrawal of, funds from, say, an investment account, an IRA account, because it's diminishing the value of that account. And yet, if you keep drawing on it, and a lot of times the draw amount's big, $4,000, $5,000, $6,000 a month, maybe more. Well, if you're still drawing on that, as the value of that account has been adversely affected by maybe 15 or 20%, like a 20% correction. If you have that reverse mortgage already in place with that line of credit with no balance, then what you can do is, when that market drop occurs that's affecting your financial accounts, stop the withdrawals from them, grab that same amount of money from your reverse mortgage line of credit, and then continue to do that until your financial accounts, come back up in value. And in fact, you should look at that year to year. So any year where there's going to be a downturn in your account value, sequence of return risk, shift your income draw from your financial account to your line of credit, and then you could switch back when the financial account is growing again. A good financial advisor can help any senior homeowner set that up and focus on that as a very good strategic tool to help overall preserve your assets, both the home as well as your financial assets, and allow them to be in place for a much longer period of time.
Art, I love that. The whole idea of don't wait to do this as a last resort. It almost reminds me of when you're getting a plane and the flight attendant will tell you, if we lose cabin pressure, put the mask on yourself first. Don't go oxygen deprived while you're trying to help people around you. Get the mask on yourself first, and then you can be more useful and helpful. I think looking at this early on and saying, hey, where are we on this situation, and does it fit for me? I think that's a great idea.
Yep.
Now, this next piece, we talked about a little bit already about misconceptions, but I know there's got to be some other misconceptions about the whole idea, the fear of the homeowners might have. Can you share any others that you're aware of?
Well, sure. In fact, this is a very timely question, because literally just in the last couple of days, I was corresponding with one of my past clients about exactly this subject. He had sent me an email pointing out the challenges of being a homeowner. I had actually arranged a refinance for him back in 2021. Interest rates 2.75, but his mortgage payments have been going up. Well, of course, it's not the mortgage payment itself, the principal and interest. It's a fixed rate loan for 30 years at 2 3/4. What's happening to him, of course, is property taxes have gone up. Insurance in particular has gone up a whole lot. And even HOA dues where the property is located have gone up. So that's the component of his housing expense that's really been a challenge for him. And I looked at his current loan balance and I suggested, a reverse mortgage may be a very good solution for your situation, because you can eliminate the mortgage entirely and not make a payment at all. And then, of course, you still have to pay that higher property taxes and insurance and the HOA dues. And it was interesting because he immediately dismissed that. And I actually wrote down some of the things that he commented on in his email back to me. He's like, I'm not interested in a reverse mortgage because they have high fees and costs. Yes and no. In terms of fees, two things. The standard core product, the HECM, you can run into some originators will want to charge you a $6,000 origination fee. Beware of that. You shouldn't have to pay that. We don't charge that. We can if we want. We don't. We get paid by the lender. Reverse mortgage is actually odd in that it's like the last mortgage program available in the U.S. where an originator like us, we can charge an origination fee to the borrower and still get paid by the lender as well. First mortgages can't do that. So that's one thing I'd say. If you're looking at a reverse mortgage and somebody wants to charge you a $6,000 origination fee, tell them no and call me, because I can show you can get the same loan without that origination fee. Otherwise, closing costs are normal like any other refi. A standard loan amount, $300,000-400,000. The closing costs are going to be maybe $3,500. Now, where the big objection is mortgage insurance. Again, the HECM, home equity conversion mortgage, is an FHA product, and there is a mortgage insurance premium, and it's substantial, 2% of the principal limit. First mortgages, FHA, it's 1.75. So it's very similar to a FHA first mortgage. Lots of those get done. I don't know why the same mortgage insurance on the reverse mortgage is so objectionable by people, but it is. But what they're forgetting is a reverse mortgage is a non-recourse loan. So what that means is if you keep that loan for many years and the value of the home, for some reason, one of those 7 years out of 75 drops, and your loan balance is higher than what the home is worth, you're not responsible for the negative balance, nor are your heirs. So neither one of you or your heirs would be responsible for that negative balance. That is the reason why that mortgage insurance actually should be embraced as a good thing, because it protects that homeowner and the borrower from having that problem in the future. But here's a few other things that he mentioned. I'll lose all control. Puts the federal government in control. Home would become the government's home. The home will go to HUD when I pass away. the lender may foreclose on me if they don't think I'm maintaining the property adequately. That's and that my heirs won't be able to inherit the home. Well, of course, I had to respond to him that none of that's true. When you get this reverse mortgage, you're not going to lose control. You still own your home. The reverse mortgage is simply a mortgage lien recorded against your home, secured by your home, just like his existing first mortgage is. And yet, with his existing first mortgage, which happens to be a VA, he doesn't consider that a case of the government owning his home. Yet, if he gets an FHA HECM, he thinks the government's going to control and own his home. Not true. It's a mortgage like any other, secured by your home as a mortgage lien, just like any other mortgage, just like his existing mortgage. The difference simply is you don't have to make payments unless you want to. And then the idea that foreclosure if the property is not well maintained. Well, that's not to mean that the government's got like inspectors who are going to come check on your home and see what kind of condition is, and then you get a letter in the mail. Sorry, we're going to foreclose on you because you didn't keep the house painted or something like that. That's just not how it works. So I think that's a fear that is way, way, way overblown. And I think as a consequence, that is an impediment from some senior homeowners from looking at this product. And they're so focused on these negative, false assumptions, this fake news, I'll call it, to use a common popular word these days, that holds them back. And they forget, or they're not aware of all the tremendous benefits the product gives them. So that is something that we still battle with all the time, but that's all we can do. We got to keep working through that and do more and more to educate people that most of these concepts, most of these impressions simply is just not true.
Art, I have to ask you, after you spoke with this gentleman and kind of, if you will, debunked the myths, did you sense any change of direction mindset wise?
Well, I didn't, only because he shared with me another aspect of his thinking that I wasn't aware of. He doesn't have any heirs, no children, no heirs at all. So his focus is to get his home paid off. And apparently, despite the fact he's struggling with all these extra costs, oddly, he's paying extra on his mortgage, which I ran into that with my dad 20 years ago, which I've told that story before. I won't do it again, and he's doing that because he wants to get the loan paid, the home paid off, the loan paid off, so the home's free and clear, and then he's going to donate it.
Oh, interesting.
So his estate planning is get the home paid off, and then in his estate plan, when he passes, he wants that home to be donated. I forget who he said he was going to donate it to, but that's a very worthy objective strategy. I couldn't argue with that. I'm not going to tell him, oh, you shouldn't do that. Get a reverse mortgage and enjoy a payment-free mortgage. Obviously, that's not appropriate. In his case, that's a very, very worthy, admirable strategy. And so once I heard that, I'm like, more power to you. God bless you. Keep doing what you're doing.
Yeah. So. Well, I know you've done many of these in your career. Give us an example of how reverse mortgage might have changed someone's life, one of your clients, because they said, oh, I wasn't aware of that. I took advantage of it, and now it's made a difference in our lives.
Sure. Again, I have another recent case. I consulted with a senior homeowner just last week, a married couple. And it was interesting because in their case, it's not necessarily the most common scenario we see. They own a home here in the Valley, high value, nearly $2.5 million in value. And they had a current loan balance of almost $1 million, $959,000. And their focus in terms of estate planning, like the other gentleman I just described, no heirs to speak of, no children. So the focus on having equity left over for heirs really is not their main concern. The main concern was to pay off the existing mortgage so they don't have a mortgage payment, which would be over $5,000 a month is what they're paying, and to try to pull as much cash out as they can. And then later on, their plan is within 3 to 5 years or so, they expect to sell the current home. And they also do expect, interesting, but it's something you have to talk about, they do expect one of them may not live much longer than that. So the remaining borrower, homeowner, wants to consider a scenario where 3 to 5 years they may sell the property, and then she would use the proceeds to buy down in value, buy a less expensive home. And of course, I suggested they could use a reverse mortgage for the purchase, and then have some money in the bank, because even with getting the reverse mortgage now, after 5 years, we were able to show them they probably would still have about $1 million worth of equity. And this was, I was able to offer them this because of a new reverse mortgage product we have. It's called a Home Safe Intro. And this is an interesting product because it addresses what we see so often. Homeowners who want to get a reverse mortgage, and they're always focused on the HECM first, but the loan amount that they can get is not enough to pay off an existing mortgage. They're short. So this Home Safe Intro addresses that. It provides 5% higher loan to value than the other reverse mortgage products. Does come with some restrictions. You can't have a credit score under 600. You can't pay off debt to qualify. You are still going to be subject to financial assessment, which is basically going to look at you to determine what your residual income is going to be after all expenses. And you have to meet that number or you're not going to qualify based on financial assessment. And you're not allowed to set up a LISA account. That's life expectancy set aside. That is a case where if the borrower is deemed to be financially not secure and may potentially not be able to maintain taxes, insurance, maintenance, and repairs, a LISA account can be set up. But with the Home Safe Centro, that's not allowed. So those are the restrictions, but it's a great way to get that higher loan amount that some of these homeowners need that the standard reverse mortgage product doesn't get them. In their case, we were able to offer a loan amount that's almost $1.1 million. And that's going to obviously easily pay off their $959,000 existing first mortgage. And they're going to be able to get access to $170,000. Now they're going to get it as a lump sum. There's no line of credit on that one. $170,000 cash in their pocket when they close. They really like that scenario. And so it looks like we're going to be pursuing that. So that's a good example of a new reverse mortgage product that is addressing a situation that we run into quite often.
Wow, Art, so that's called a Home Safe Intro.
Correct.
Wow. Okay, so the cool part about that is not only do they get some money at the end, $170,000, but they no longer have that payment on that $959,000 loan. So that's a real turn of events. That's amazing.
Exactly right. Yeah.
Wow. Well, for those people who are watching, we've had a nice group of people watching today. Tell us a little bit about, if they're curious and they're unsure if they qualify, what's the best next step and how it is to find you and see if they qualify.
Well, obviously, the best thing to do is contact us. Contact me. My phone's on the screen there. You can call my cell number, send me an email. Let's have a conversation. I'm pretty friendly. I'm not high pressure. That's not my approach. I want to have a conversation with homeowners and first of all, address their concerns and their maybe misinformation that they're thinking about, help them realize that much of those thoughts are not accurate. And then if we get past that point and we start talking about the details, one of the things we can do is based on some very basic information, essentially their birth dates, the property value, the zip code, and if they have an existing mortgage or not, then we can start with a reverse mortgage illustration that is going to lay out some specific numbers that I can go over with them to answer all those questions that they're going to be concerned about in terms of what the interest rate is, the closing costs, how much is the loan balance going to go up over time, and so forth. So I address all of those. And then if they are still anxious and motivated and excited about the opportunity, then we can take the next step and get them a full proposal package. And that's an important piece in the process because part of that package includes a list of home ownership counseling agencies, because with reverse mortgage products, you do have to go through counseling to learn more about how the products work. And again, that's a consumer safeguard approach. It's typically done by phone. You don't have to go anywhere. There is some cost to it, but it's not horribly expensive, usually 150, $200. You do that first, and then once you do that, 7-day cooling period, and then we can get you fully into the process.
Well, the other thing I noticed is you've put together a program to discover if a reverse mortgage is right for you, and it's a survey of 25 questions.
Yes.
I thought that's really a cool idea, and there's over 2,100 people that have gone through this with you to discover this. And the cool thing about this is not only it asks you questions that would pertain to you being, let's say, an ideal candidate for this, but it also gives you a report at the end letting you know step by step, hey, in these 5 or 6 areas, could this be a difference maker for you? So I thought that was kind of cool. And as I say, it's a free assessment. You can see the link here on the screen. And as I said, there's only 25 questions, and it gives you results at the end. And if it's right for you, give Art a call. His number's on the bottom there, 760-969-5023. If you feel like, hey, I want to take a step before I call Art. Although, he's probably gonna ask you these same 25 questions, and he'll give you the assessment. The only thing is you don't get that cool readout, but you can do that.
Well, yeah, and the good point about this assessment is, yes, it basically gives them those questions to answer. And so then when they call to inquire further, I'm armed with what their answers are, and that better informs me of what their situation is, so that I can have a more detailed discussion about the pros and cons and whether or not this is right for them. And of course, the issue with these kinds of assessments, and we've got this online and so forth, is folks are worried that if they go through that process, that they're going to then start getting harassed with phone calls and text messages, and we're just going to come after them aggressively. And that's not our approach. We don't want to do that to anyone. So I would encourage anyone, if you come across this, go ahead and go through it. It's a helpful tool to help you further evaluate if it's the right product for you.
Well, Art, I think this has been great. As always, you do such a great service for people, no matter what age they are, to help us make better decisions going forward. And really, as you pointed out, there's still people out there who think this is not a good idea. It's totally different than what they may have heard of. And if you're just joining us, make sure to go back. You just hit rewind and listen to Art, how he explains how this works for you if you are a senior homeowner. And in that situation where you're like, hey, I'm not sure I've really made a really good plan going forward. Art, thank you so much. I appreciate it. I'll turn it back over to you.
Okay. Thanks, Jeff. Thank you, everyone, for watching and listening to this week's Mortgage Minute. I appreciate your time and attendance to this program. Have a great weekend. Look for that French Open tennis. That's going to be fun, and the NBA Finals. As I said, we're going to get toasty here next week. It's going to get into the well above 100 starting on Monday. So stay cool out there if you're here locally. In the meantime, we will see you next week on the next edition of the Mortgage Minute. Again, Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.